Hi everybody and welcome along to the Mint Monthly Update. Today it's myself, David Fyfe and John Middleton, just talking about the month that was for January and our single sector funds. Rolling through the disclaimer. Now, just thought I'd start by setting the scene in terms of looking at what the macro outlook for New Zealand is for the year ahead. It's certainly been a volatile last year in terms of rates, inflation, and key monetary policy decisions. But I guess, where are we now starting the year? I think one of the key pieces on the left you can see there is the inflation. And at the moment, we're still sitting in the last read at the sort of top end of where the RBNZ's happy, just above 3. Certainly surprised a little bit. I guess it's broken into two key pieces, both tradable and non-tradable. In terms of the tradable, I think the outlook is generally a bit more positive in terms of we expect some of that to come back. We've seen, for example, a bit of inflation in food, also fuel, but that's expected to sort of normalise in the next while. In terms of non-tradables, it's a little bit stickier. We're certainly seeing issues around whether it's council rates and other areas like electricity prices certainly continue to track through, which is something of a little bit of a concern, but there's not a lot we can really do in that space. But yeah, it is certainly something we're keeping an eye on as we think about the monetary policy settings with the RBNZ. And even today, of course, we've seen them sort of lift the track a little bit, but outlook for the year is probably one hike. I wouldn't expect more than that because, a big piece of that is really the chart on the right, which is unemployment, a key part of the country's growth and in terms of where the capacity sits. And, right now, if you look on that chart where we're sitting, it is at a sort of high ebb versus where we'd normally be in a cycle. And of course, we know that we're sort of expecting the macro conditions to recover a little bit. But, this is a chart from Westpac here, and you can see they're expecting that to come back in the next while. We'll probably stay at high levels for a little bit, so there's certainly a bit of leeway there. So I guess, we think about the year ahead, it's a little bit of a transition phase. Inflation's not fully beaten yet, but it's still there. And growth is slow, but slowly ticking up, and we're sort of seeing that, especially some of the confidence surveys. So that's been an interesting one. So we should expect a better year ahead. Now, moving into the funds themselves, it was a tough start to January, a little bit quiet on news flow. It often is. We had a few updates, some from companies like Infratil with their CDC valuation uplift, which was again a rather large number for that business. So we're keeping an eye on that position. In fact, this is an update from Infratil from CDC coming in the next month or two in March with a investor day over in Sydney. So one we'll keep an eye on. But in terms of news flow, what we did see, A2, I've got a chart on the screen here. We actually got an update from the Chinese government statistics department around births for the year. And it was actually a really soft year and did surprise. If you look at the chart there, last year was particularly strong. It had a recovery in the birth rates in China, and that was driven by the year of the dragon, which is seen as particularly lucky to have kids in. But, you can see the trend normalised to something just under 8 million births. And as you see by that chart, that was almost more than double that less than a decade ago. So it is something we watch closely for A2, basically on the back of the fact that, the market share required to maintain some solid earnings growth it can be challenging. But as I sort of mentioned on the chart there by the title, execution is key. And we'll touch on it next month, but so far the reporting we've seen from A2 this year has proven that they are executing well. So it's been an interesting one and an underweight that we've traditionally had, but closed up more so recently. So it's an interesting one from there. In terms of other news, what do we get out in January? We got Fletcher Building selling their construction division, somewhat expected, but good to see. Additionally, we got an update from Tower around some cost out from shutting down an office in Rotorua, and that's sort of seen that stock perform reasonably well. Additionally, it's also seen lower claims, and we've actually had an AGM update today again, pointing to the fact that claims levels are a little bit lower, even with some of the weather events we've seen locally. They are covered for those in terms of large events, but it's the claims cycle is still slightly supportive on that front, and it's really just about growing their GWP growth. And that's probably it. It's been a pretty quiet one, so we'll touch over next month's reporting season. It's sort of a lot of expectation for a better outcome locally, and we're starting to see that with the last couple of results. And in fact, we've seen a decent capital raise from Contact, which we continue to support and be a part of, as we see that as a pretty positive outcome. I'll pass over to John for what happened in the Trans-Tasman market.
Yeah, thanks, Dave. So moving across to Australasia, again, fundamentally a difficult month for the fund and for markets in general. For the most part, NZ did okay. Face value, Aussie did better, but when you dig into that, it was really just gold and utilities and what energy companies that fared okay, and the rest of the market struggled. Looking at the fund, we did have a couple of highlights. Again, Dave's mentioned A2, added a little bit to the Macquarie investments, and then Ryman probably struggled a little bit on the expectation that Kiwi rates will rise over the medium term, albeit we don't necessarily agree with that in terms of rise materially. But unfortunately, the same theme as the last couple of months, tech traded heavy, and Xero and WiseTech were amongst the names that weighed on the fund's performance. I suppose segueing into the chart on the right, what did we do? Well, to be honest, we continue to invest in those IT software names, which we think are becoming an increasingly attractive proposition. The chart on the right essentially shows you Xero's valuation over the last decade, looking at it on an EV sales basis. Why EV sales? Well, basically because it went from sort of loss-making to profitable. So, earnings-based multiples don't really help too much. And again, fundamentally, it charts a sort of more conservative view of the valuation over the medium term. So the green is basically the share, the price of valuation over time, and the red is where we started to get in. So, we started to buy Xero at the back end of last year. Multiples having come down materially, and again, the interesting thing is it's basically halved since then, and is now trading on an EV to sales of about 5 times, which is essentially the cheapest it's traded in a decade. And I suppose the point I would make on that is twofold. First of all, when we look at the business, are we buying the same business that we did a decade ago? And the answer is quite simply no. I think, even with the best sort of benefit of hindsight, the Xero business a decade ago had a solid position in New Zealand and Australia, and I suppose the jury was out on the UK and the US, and also things like payments. If you roll forward to today, it is the dominant play in Australasia. Essentially the main accounting software used over here. It's got a very strong position in the UK. Okay, the jury's out a little bit in the US, but they have added a pretty interesting payments business in Melio, and should grow that business going forward. And the reality is, if we look at the Aussie business and the Kiwi business on its own, we think that supports the current share price. So again, the software side of our portfolio has weighed in the last 6 months or so. We have actually continued to add to that position, which has hurt in the short term, but we do think we are getting access to these sort of assets at what are, very interesting prices, notwithstanding the AI threat. And just to touch on that, again, we think AI is actually an enabler rather than a detractor. If you have high barriers to entry and interfaces with things like banks and accountants and basically the government, we'd be surprised if AI really undermines that market. And what it does bring is the ability to improve your product a lot faster than you have in the past. So again, I think there's still volatility in vagaries, but I think with earnings will demonstrate that these businesses are here to stay, and valuations are attractive. Elsewhere within the fund, again, we've added a little bit of Fisher & Paykel Healthcare weakness, and Auckland Airport ahead of what we expect to be a strong rebounding in earnings over the medium term. And again, one of the slight things that happened over the quiet season was a major offshore seller of EBOS sold some stock, and we took advantage of picking that up at what we think will be an attractive price. Moving across to the property fund. Again, interesting that we have had this sort of change between the rest of the world and Australasia. Certainly the rhetoric in the rest of the world over the last couple of months has been moving towards central banks cutting rates to stimulate the economy, while in NZ and particularly Australia, we've gone the opposite direction. Inflation has stayed stubbornly high and has caused the RBA to increase rates. And that has obviously weighed on the property sector in general, and the Australasian side of the sector in particular. And hence, the Kiwi index was off almost 4%, and we fared a little bit worse than that, given we've got a little bit of investment in Aussie. Where does that lead us? And I suppose, the interesting thing there is we start to think about balance sheets and quality of earnings. Again, moving us back towards the quality end of town, which is, you know, a pretty comfortable space for us. To be honest, we don't really think there's a major threat, because we think, you know, any rate hikes will be very much back-end loaded. And the good news is that the chart on the right, you know, we are seeing the market sort of moving again in terms of transactions. And, you know, almost surprisingly, in New Zealand, we did see at the end of the year quite a number of transactions take place. Yes, they are marginally dilutive in the short term. You're selling, for the most part, you know, relatively good earners. And, you know, whether you're using that cash flow to fund future growth or to pay down debt, you're still getting that cash in the door. So I think the concerns of deeply discounted rights are behind us. And as we've sort of said regularly, I think the dividends are safe. Having said that, you know, again, I think, you know, clearly people are positioning to fund future growth. And again, we prefer that quality end of town, which can grow, you know, well without really needing too much capital. So what have we done? Well, we've taken a little bit of cash out of Precinct and Stride and put it into property for industry, which again, I think we've been sold off to interesting rates, and added a bit of Auckland Airport back into the fund. Anyway, I hope that was of interest. That is the end for us. As usual, if you have any questions, please drop us an email at info@mintasset.co.nz. And as Dave mentioned, obviously we're currently in the middle of reporting season, so lots to talk about this time next month. Appreciate your support.